I'm Dylan Marma, and you're listening to Operators and Allocators, a podcast dedicated to exploring how to make smart investment decisions and execute well in real estate and private equity. We'll be interviewing top-notch sponsors from various asset classes to understand how they think and the frameworks that they put in place with the goal of achieving above-average risk-adjusted returns. Welcome back to another episode of Operators and Allocators. I'm your host, Dylan Marma, and today we are joined by a guest that I'm very excited about, none other than Mr. Jeremy Roll. Jeremy started investing in real estate in 2002, and in 2007, he left the corporate world to go full-time investing passively. He's invested in over 60 opportunities totaling over $1 billion in real estate. He's the founder of Roll Investment Group, in which he manages a group of over 1,500 investors who seek passive managed investment opportunities. And he's someone that I've had the pleasure of being introduced to over the last year who provides unique insight and perspective coming from the fact that he's mainly a passive investor, or pretty much at this point exclusively a passive investor who's had the opportunity to partner and work with many different operators over the years. So welcome to the show, Jeremy.
Thank you. Thanks for having me. I hope this is helpful for your listeners.
Yeah, we're definitely excited to have you here. So tell us how you got your start back in 2002.
Yeah, so honestly, I got my start in 2002 after the dot-com crash. For those of you who remember the dot-com crash, really for me, it was all about, in response to the dot-com crash, which was just like watching the market go up and down 30% in a year. I'm a really low risk guy, and I was trying to figure out how do I invest long-term for my retirement without the same level of volatility and with more predictability. And that's when I eventually turned to real estate on the passive side. And I've been really focused on predictability ever since.
What were some of your early investments like? Is there anything that you learned from those early ones that changed the way you looked at later investments?
Oh, I mean, yeah, there's always a ton of learning. I started early. So what's interesting about my story is that when I first started, I immediately started investing with the lifelong friends of my family who I had known their sons, as my friends probably since I was 5 years old. So it was a little unique because I was able to learn probably unusually a lot from them because of my relationship with them. So I started investing with them, and I started off investing in what they were focused on, which was office and retail and industrial. And it was a really good starting point because it's a lot of unique learnings you get because, multifamily, for example, is easier for a lot of people to understand because a lot of us have lived in apartment buildings. We understand how it works. It's somewhat straightforward. And so got a lot of learnings there. And then, I've seen so many deals over the years. You mentioned I've invested over 60 deals. I'm actually currently invested over 60 deals. I've invested in many more than 100 deals over time. So across many different things, including non-real estate. I have a ton of learnings. I would say the two most important takeaways from all of it that at least come to mind. As a passive investor, I think it's even more important who you're making a bet on versus the actual opportunity itself. Now, the opportunity itself in the property is second, very close second place. But who you're making a bet on can just have a huge influence over the outcome, regardless of the state of the property and where it was at to begin with, And then the other thing I've learned is when I came from the corporate world, I was actually working at Disney headquarters and Toyota headquarters in Los Angeles, my last two jobs. And I was just having things buttoned up, nice presentations, people paying a lot of attention to the looks of it and everything. And what I learned over time is that I'd rather invest with the best operator with the worst documents than the worst operator with the best documents. This is kind of my expression. And I think that's really hard for people to grasp or break through or understand sometimes, right? And it was hard for me to understand at the beginning, where you may be turned off automatically from a document that doesn't look 100% professional. I'm not saying it should look 0% professional, but sometimes some of the better and in fact, I'm investing with an operator right now who does not have the best documents because they hate the concept that they're going to be a marketer. I showed them other similar competitive offering documents, and I sent them one 2 weeks ago. This is someone I've been investing with 15 times now. And I sent them one 2 weeks ago. I said, this is what your competition does. And they 28 pages into this offering document, they said, I'm still reading fluff. And that was their mindset, right? They don't want to be marketing. They don't want to be pitching people. It doesn't mean they're a bad operator. So, reading between the lines and not necessarily falling into the trap of investing in the sexiest, coolest presentation, I think is absolutely critical. And sometimes it's those people you want to stay away from because they're a great marketing machine, but that's what they're focused on, the marketing, and maybe even not worried as much about their performance and operational execution. So those are two really key things that I learned over time. And that second lesson I just mentioned occurred to me relatively quickly, but it was hard for me to adjust because I was so used to seeing polished pieces of stuff within the corporate world.
I love what you just mentioned there, and I want to get back to that. But first, I want to start circling back to when you started off. You got straight into investing into syndications as LPs. Did you have any time trying any turnkey or anything like that, or you went straight for the LP investments and never looked back?
I went straight for the LP investments. Part of the reason was I was at Disney headquarters at the time. I was crazy busy. I remember I was on the phone on my cell phone talking to people because we were multi-floors of my division. It was a cell phone I was paying for myself, like in between two meetings on the cell phone, taking care of stuff. And I was doing stuff at night. And so I didn't have time to be more of an active investor. And so I started on the passive path out of necessity. But what I learned is that, and this is really key, is that ended up being coincidentally a really good personality fit for me. Mm-hmm. And sometimes one of the considerations is definitely personality fit and active versus passive, and what's the best fit for somebody. So completely. Yeah, that's why I continued down the passive path.
So you bring up a great point. I think today's day and age, everyone is competing for attention. Lots of people out there with podcasts, lots of people that are very active on social media marketing. And at the end of the day, it's hard to identify who's the real deal, who's really giving the operations the time it needs, or who's really just raising money and then looking for the next deal as soon as they close on the opportunity in front of them. So how do you distinguish that? What are some ways that you can quote unquote test or vet operators to get a general sense as to whether or not they're really giving the operations the attention they need?
Yeah, good question. And yeah, to your point, I mean, the podcast probably became popular, I think back around 2015, plus or minus a year, and, really ramped up from there, and has really changed the landscape of education for investors like me, and also the reach of being able to access a lot more sponsors versus just in-person networking that was required in the past. It's changed things. I will say, though, that I try to caution people all the time. I say, first of all, just because someone runs a podcast well and has a great podcasting brand and a big brand doesn't necessarily mean they're going to run in real estate building well. It's two separate businesses. And I think a lot of people tend to attach too much equity to someone's podcast and image. And granted, I think it does tell you a lot about the person, because you could tell if someone's smart or not, if they're asking the right questions, if they're thorough, if they get the asset class they're focused on a lot by listening to a lot of their podcasts. But you're not analyzing their operations and their execution. You're analyzing their ability to sound smart and interview well other people on a podcast. Mm-hmm. So I think it's important to separate those two. And what I like to tell people high level is that I try to find sponsors who are, first of all, a good personality fit for me. They're conservative, who are looking to use conservative assumptions that tend to underpromise and overdeliver almost purposefully, so that they're trying to build long-term relationships with investors by overperforming. What I'm trying to avoid is marketers who are trying to be aggressive in their assumptions, use really attractive numbers and great marketing pieces combined.
Yet say they're conservative.
Yeah, they're the opposite of conservative, where they're trying to just attract investors, market as much as possible. They're less concerned about execution necessarily and more concerned about their fundraising pipeline. And if I don't reinvest with them, they're just going to move on to the next person they find. And so high level, that's the philosophy that I have. But the important part of that is not just as obvious, it's just that also that I'm looking for a conservative person that fits well with my personality. And there's a number of sponsors over the years I've connected with where when they send me a deal, I'm going to really kind of dive into it and really get into the nitty gritty. I know if they're sending me something, probably 8 or 9 times out of 10, I'm going to want to move forward, because we're so on the same page with how we analyze a deal, what we're looking for, and how we vet a deal, and the way we think about assumptions, that it's a personality fit, right? And so I would caution somebody, if you're looking at a deal and there's all kinds of things that don't quite fit what you're looking for, there's a lot of other deals out there. You're going to want to look for the right personality fit and for someone who aligns with the way you think and what you believe in the correct assumptions should be. But I think digging into assumptions is one really good way as a starting point to figure out if you're on the same page with somebody and how they're thinking.
What if someone is not quite as familiar with the assumptions in the beginning? I think that's the problem a lot of people have is I look at an operating agreement and can pick apart the line items that look aggressive, right? And I'm sure you can do the same at this point. But in the beginning, that's the hard part, is no one can tell what the expenses should be. Right.
And so I think that learning one asset, I would always, and I'm not a financial advisor or investment advisor, I should have said this at the beginning. So anything you're getting is just my perspective as an investor with no financial advice or investing advice. But I would recommend, if somebody asked me that question, that someone start with one asset class first, and the one that they're most familiar with off the bat. So if you've grown up and lived in 10 apartment communities, and you happen to understand those best, and those are going to be the easiest ones for you to get your arms around, start looking at apartments. If you grew up in a mobile home park and you've lived in several and you understand the operations of that, start with that instead. That's going to be easier for you to understand, right? Because I tell people an expense ratio and other things, a lot of these things and assumptions are transferable, 60 to 90%, depending on the asset class, across asset classes. So you're going to create a core foundation of understanding by learning one asset class, and you can apply and adjust and tweak to other asset classes. But I would tell people to start off, learn as much as you can, and don't go into a deal until you're able to fully understand and analyze it. Because short of that, you're increasing your risk. You're going in a little more blind when you don't need to. But you owe it to yourself to learn, because if you don't learn, you're going to take more risk than you may even understand you're taking.
So I think this will be my last question on vetting the operators, which of course I think for you is I think you have so much value to provide in that realm. When you're vetting an operator, is there any particular questions that you think are must asks for LPs?
Yeah, so there's two things that come to mind immediately. First thing is an absolute requirement for me is running a background check. And I'm pointing this out because I'm going to wager that 9 out of 10 LPs do not run background checks or more. That's my experience, just asking random sample, right, of people. And I think that's just a huge mistake by some of the limited partners who are considering investing passively. I have a mandatory background check that I run every time I invest, even again with somebody, because something could have changed. And that's number one. So I always ask, and what I do is almost as a test in that process is I will ask somebody, I need your name, date of birth, and home address, and I need each managing member. That's what I do to get their information. And that's one test to see, like, is this person going to give me that information? Are they going to hesitate? Is there something they don't want me to see? That type of thing, right? And so that's one thing I think that's important to consider, both as far as a test, but also actually executing on your own. The other thing is, as a general philosophy, I ask a lot of questions to sponsors, almost not because I need to know the answer, because I need to know how they're going to answer. And you need to really read between the lines. And you can do so even in reading some of the overviews. You can kind of start to get a sense of someone's conservative. Did they use the line, we assumed a 2% rent growth per year, even though we believe it's going to be higher, to be conservative, right? If they use that verbiage, they're being conservative. That's their mindset. If you ask somebody, why did you use 5% rent growth each year for the next 10 years? That seems aggressive. Well, we've seen that the market has done that for the last 2 years, and we think that's going to keep going. Okay, maybe they're right, maybe they're wrong. We just know they're not being conservative, right? And so you can ask a lot of these things and then read between the lines. So I would encourage people to do what I would, which is ask a lot of questions of reading between that are meant to read between the lines as far as the answers, and how they answer is more important than what they answer sometimes.
You're probably, I would imagine, going for almost a gut feel at a point, because you've spoken to so many operators. You're probably going for somewhat of a gut feel on how much are they trying to sell you versus how much are they trying to sort of paint an accurate picture and things along those lines. Would you say?
Yeah, well, actually, I would say this. I would say that I always do a gut check in the end on any deal I'm looking at. And if there's something in my gut telling me not to do it, then just move on to the next. So there's always a gut check. And you're going with a little bit of a gut feel because some of this is intangible, but always do a gut check in the end. And it's just never worth moving forward unless you're 100%, because these are illiquid investments. They're hard to get out of. They're long-term commitments. You're making bets on people, and you're giving people control. So because of all those reasons, it's really important to feel 100% comfortable going in, regardless of the outcome. You want to go into it in the best possible position.
Completely. Well, there we have it. I think that was a great message for everyone when it comes to vetting operators. And it reminds me of what I believe I first heard from the Ray Dalio book, Substance Over Style, right? Vetting the true substance over the style and the front end appearance. So I want to shift gears a bit into today's market and what you're seeking in today's market. So what are your deal criteria today?
So given that I'm a low risk person, what I'm choosing to do for the most part is sit on the sidelines at this very moment, wait to see how this all plays out, because I don't think it's going to be very long for us to discover the results of all this and then potentially jump back in. So it's interesting timing that we're talking, because there's just a lot of moving parts at the moment where the outcome is not obvious. And but I will say this: I always invest. I'm always making investments. I'm always looking for unique investments. And if something's unique and can still make sense despite all the other things going on, I'll definitely invest in them. I mean, I can't tell you how many investments I've made in the past 6 months, but it's been easily probably 7 to 10 plus. Just to give you an idea, I would say each of those is unique. Some of them are not real estate related. So there's a whole slew of reasons why each of those made sense to me, but they weren't what I would consider to be a normal market rate deal at this timing, just because that's where I'm having a challenge right now.
It seems there's a few different trains of thought right now. There's some are on the sidelines, which I think is always an intelligent move, and it takes having patience and watching opportunities go by. And then there's another class of people that are all experiencing FOMO, and they're trying to put as much in as possible so they don't miss out on this possible wave of inflation.
Yes. And I mean, I've even read economic analyses that, in fact, one recently that says, I just read one yesterday from a major bank saying the demand was pulled forward so much by all this money printing, that would have occurred later on, that we're already halfway through the economic recovery. So the NBER, who publishes, they're the official people who track US recessions, just published yesterday that the recession that we had last year is come and gone, and it was 2 months. It was a record short period of time. March and April 2020, that was the recession, if you could believe that. I have a hard time believing that's all we're going to have, but that's what they're saying. And but what's come of that is that some people are saying we're literally already halfway through the economic cycle, because we literally accelerated multiple years of spending, and that we only may have 2, 3, 4 years left before another downturn. So there's all different theories out there, right? And the most important thing is that you spend a lot of time researching and developing your own opinion, because there's no way to know who's right, who's wrong, and you just got to do what you're comfortable with. I would say that by sitting on the sidelines, it's a great comfort level for me, but I have a lot of opportunity cost, and someone who's fully deployed all the time is probably going to do better than me long term, right? Mm-hmm. They're going to kind of more risk, more reward type of philosophy. And so just got to do whatever is best fit for you.
Is there any advice you have for someone that is not as tuned into macroeconomics, or not really making a firm stance on the direction of the economy and things along those lines? How can they still get in the game and stay investing strategically?
Look, I know that's really tough for some people. I do this full time, and to be fair, I do a ton of reading for this exact reason. So I read probably on average 2 to 3 hours a day, easy. And that's a lot, I know, because I do this full time. And it's the first thing I wake up, literally, I'm in bed reading on my phone, the news, the markets, real estate news, like literally for the first hour or two, easy. And so I'm a big proponent of that. And the reason is because I go into a lot of longer term deals, and they're very liquid. And so I'm locked into a deal often for a 10-year period, or could even be longer, right? So what does that mean? That means that I have to have an opinion about societal trends and economic trends over a 10-year term. I could easily be wrong, but I've got to do my best, right? Because I cannot pull out of a deal 5 years later and press sell because I made a mistake, right? So I would say that if someone's having trouble with economic trends, because I know that could be complicated, I think that what I would recommend they consider is higher level, one step up, societal trends. Let me give you an example. And because I think this is easier to understand for people. On average, get rid of the pandemic, what was happening from a demographic perspective and from a population shifting perspective is that we're aging, population was retiring south, okay? And it's still happening. So that's why Florida and Texas are number 1 and number 2 projected population growth for the next 10 years, okay? But just philosophically, I think a lot of people know people are moving south, right? So if you're looking at a property in upstate New York, no offense to upstate New York, I'm from Montreal, even more upstate or higher. So nothing wrong. I love upstate New York, beautiful. But the population projections for the next 10 years are not good compared to the population projections in Florida, Texas, Arizona, right? That's just a fact. And a lot of people just intuitively already know that because they've seen it in the news. And so consider that when you're investing, right? Are you investing in a market where there's hurricanes? And are you investing in the type of asset class that can withstand a hurricane without much damage? Or are you going to be completely exposed, right? Are you investing in a mobile home park on the water that could be blown away? Or are you investing in a low-rise self-storage property with no windows that probably won't be so bad, right? So I would say just think more high level at stuff, at what may make more sense for you. Think longer term trends. People are buying more stuff online. That means if you're going to invest in retail properties, your risk may be higher. You have to research it further. It may or may not be, but just the easy high level, like what you know is going on, right? People are shopping more from home. That means the malls may be less in demand. People may be working more from home. That means office space may be higher risk in terms of the current supply versus the future demand, right? So I'm not telling people that they have to know what the GDP growth projected is for the next 3 quarters, right? If they don't understand that. But I think it's fair for people to apply their general knowledge and try to avoid some of the landmines if they're not able to dig into all the economic stuff. And you got to think 10 years out in economic trends. You got to think the potential for self-driving cars, electric cars. How will that influence certain asset classes and demand for asset classes? You got to think about internet, increases in internet speed, increases in wireless, and just try to think as best as you can about how that could impact what you're investing in.
I think that's great advice. I'm one of those upstate New Yorkers that's down here in Florida, and I'm sure we all know multiple of them, right? So it's something that we see in our everyday life, and a lot of these experiences can be anecdotal, but I think collective experiences that you see happening across the country, and it doesn't take that much outside of just pure observation and common sense to be able to use some of these underlying assumptions. I think what I take is that if someone doesn't have quite as good of a pulse, asking the right questions, but probably most importantly, be thinking long-term, not as much about what things look like today, right? Is there a tenant in the place today? But
Yes.
what is the potential 5 years from now for there still to be a tenant in there, and where are things moving?
Yes, and that's, I think, similar to background check, I just don't think enough people think 10 years down the line. And I mean, maybe some people aren't investing in 10 years, then it's okay. But if you're investing in a 10-year deal, which can be common, then you need to really be able to think 10 years down the line. And for 2 reasons. The first is, we don't know if rents are going to be able to maintain their pace wherever you're looking to rent from, or wherever you're looking to invest in the future. And if demand isn't going to be there, whether it's upstate, any state, right, versus down, that's going to be a challenge for you down the road, and you may not meet the business plan and projections. Even worse, there may not be as much demand for that property that you're looking to resell. So the actual pool of buyers down the road may be smaller, and you may not be able to get the price you thought just because you invested in the wrong area that was less attractive, because those next investors are going to be looking for growth areas, for example, right? So it really is important to think as far ahead as possible. I think that's a really key.
Yep, makes a ton of sense. What is one unpopular opinion that you hold?
Well, I guess sitting on the sidelines is unpopular. And I say that because, let me give you an example. I mean, this is going to sound very extreme to a lot of people. Philosophically, I have been on the sidelines since the end of 2016. Okay. That's a long time. I was on the sidelines between 05 and 08. That was a long time. This is really extreme. What happened in 2016 is that I thought every asset was overvalued market rate, except for unique situations. I thought I was just on the sidelines in general, but I was still investing, but in unique situations. In 2018, President Trump had stimulus measures that would normally never be used at the end of a cycle to prolong a cycle, but that's what happened. We prolonged until 2019-20. We were just about to go into an economic downturn. The pandemic hit. More stimulus, unbelievable amount of stimulus that's now distorted all this, and I'm having to wait on the sidelines to see what's going to come of it, right? So, but keep in mind, the reason why I'm behaving like this is because I get into 10-year long-term deals. I've got to have some sense of predictability for 10 years. And if it's not there, I'm going to wait to see how everything unfolds. So I think that's very unpopular, because a lot of people can point to me and say, what the hell are you doing? You've been on the sidelines. You haven't deployed as much money as you normally would, and you're not going to do as well long-term compared to the person who is putting all their money to work, right? And so far, that person's correct. Is there going to be an adjustment? Is that person going to get, sidelined by some adjustment finally of an actual economic downturn and an adjustment in cap rates? Yet to see. But it matches my personality right. But I think it is probably unpopular because there's a lot of people investing right now.
Yeah, it seems like that. And that can be out of a justification too, right? Versus a real belief. That could be some people investing could be justifying why it's a good time to invest versus having a.
Well, I'll tell you what I've done as a result of this. I've tried to pivot and say, okay, what makes sense now instead? And so, for example, I've done a lot of shorter term stuff, 1 year type of term, or very quick payback type of stuff, where if there is a risk in a year from an economic or a foreclosure or whatever, an eviction moratorium and all that perspective, the other alternatives seem to have a decent runway, but just for a year. So I've done a lot of hard money lending this year, much more than normal, because of supply and demand imbalance in single family home. Hard money lending, for those of you who don't know, is lending against to a flipper who's buying and rehabbing and flipping a home. Think about supply and demand imbalance. Sounds like a good place to be lending on someone who's going to resell a home in a few months, right? So I've tried to pivot and do short-term kind of stopgaps, so to speak.
Those spreads are still just as high in many ways. I think the yields there are still just as high as far as where they were a few years back too, even though interest rates have went down.
So again, me being conservative and probably unpopular, I stopped doing hard money as a general principle in 2015 because, if you go all the way back to 2009 to 12 in California and LA, just as an example, I was able to get 3 points plus 12% very easily. That was standard. Okay. Then that went to 2 plus 10, probably in about 2013. Okay. I'm just generalizing. And then in 2015, then you were looking at like maybe 1 or 2 plus 8. That's when I said to myself, I'm pivoting. In fact, what I do is I don't pivot. I just remove that from my menu of things I'm willing to invest in because the risk reward, it's the same risk, but the reward's much lower. And I tend to shift away from what's hot, right? So in the concept of shifting away from what's hot, I've shifted away from everything at some point. That's what happens at the end of a cycle for me, right? That's the way that I work into a cycle. So, but right now, again, I'm trying to cater to short-term stuff that makes sense to keep some money working, which is very difficult to find in general, but hoping to redeploy into longer-term stuff because longer-term predictable cash flow is what I'm really seeking.
When it comes to operations, that's of course a crucial part to any type of real estate. When you're multiple layers away, right, having the sponsor and then having a third-party manager, how do you ensure there's quality operations? I imagine most of that has to be on the front end through the sponsor group, but what do you look for? Are you looking for them tracking certain metrics? Are you looking for them reporting on certain metrics? Do you prefer vertically integrated over third party, or would you rather have reputable third parties in the mix?
Yeah, I prefer vertically integrated because I feel like someone's going to have more control and can take a much quicker action to change or to fix a problem. That's not always the case. And if you have a really big sponsor with a really good track record who really understands how to manage those companies and works with some good ones and hasn't switched up companies often, then that could work as well. But I strongly prefer vertically integrated when I have a choice. One thing I would tell people to watch out for is you can ask somebody in the past 5 years, how many times have you changed management companies? Because if the answer is like 5, that's a problem. If the answer is never, that's an interesting sign. And that does occur. If someone's matched up with someone really well and they're a big sponsor and they've scaled, but they've got the really good third-party property management and they've really nailed it with this one company, that can work too. But that being said, I strongly prefer internal. Once you get to a certain experience point where somebody has actually built up a large enough portfolio and they're doing internal, then they're going to be tracking all their key performance indicators, et cetera, if they're doing well for themselves and you're looking at their track record. So that almost comes by default. Where I think you're taking a risk is if somebody is either switching into internal or is trying to switch from internal to external, is making a change that is changing what they've done that you're able to base a track record off of. That's definitely a big risk point as well to look for.
Yeah, completely. Definitely agree with that. Or if they're maybe moving into new markets internally, right? That can be
new markets, always a risk point. I have seen so many instances over the years where somebody thought that this multifamily deal in X market was going to make sense, but they didn't really understand the location well enough. And it could even be just that location in that market, right? So you're increasing your risk anytime a sponsor is doing something different or something new. And I don't want to make it sound the wrong way, but essentially, like if you're the first person's first deal ever, they're going to learn off your money. It's an automatic. That's what's happening, right? If you're that person's 20th deal, they're doing a lot less learning off your money than they were to the first deal. So it's the same thing if they're moving markets or going into a new market or all these other things we're talking about. So I would look for all those things to assess how much risk you're really taking on.
We all learn from either our own mistakes as well as from the mistakes of others. Of course, one of the goals of the show is to help listeners do the latter. What is one painful learning lesson that stuck with you that you have that's worth sharing?
I invested in a student housing. This is the only foreclosure I've ever been in. Okay. So I've invested in a 302 unit, I think it was, multifamily property, student housing first property across from a State University campus in Michigan. Great location, January 2008. My thesis was we're going to have a downturn. And we talked about that already. I was on the sidelines mostly. But people go back to school during a downturn. There's going to be big demand during a downturn. This is a great kind of counter-cyclical bet. 17th asset that the sponsor was purchasing really highly, and all student housing, really well versed in student housing. But we assumed a loan, and the loan came due in 4 years, okay, which is really not a bad timeline, honestly. Going into recession, that's a pretty long term to not be worried about liquidity, right? So everything goes well. The thesis holds true. A lot of demand at the building. We're like 100% occupied or within a point or two every year. 2012 in the spring, everyone gets a notice that lives there, including the building, from the city. And they say, look, we have to close the bridge to campus over the summer when the students aren't here because it has to be repaired. It was the only way to get to campus, okay? So now, some students got really concerned that they wouldn't open the bridge in time for school. So we went from 100% occupied to 65% occupied, which would have been pretty much break even or very close to it either way. That wasn't the problem. The problem was the loan was due that fall, okay? But so like, you know, when you have an airplane crash and it's a modern airplane, it's not one problem, it's 5 dominoes, okay? So this is the domino thing. So domino number 1, you know, that came out. Nobody could have predicted that, right? Domino number 2, it was actually at the exact same time as the loan coming due. Nobody could have predicted that, right? Domino number 3, instead of extending the loan for a year to like enable us to just carry forward and get back to 100% occupied, the bank wanted the property, which is very unusual. So they said, sorry, can't extend the loan, right? We've been performing on the loan the whole time. We were 100% occupied all the other time. So they go foreclose on the property, okay? Sponsor feels really bad for the investors, says, you know, I feel really bad. We couldn't have predicted this. I'm going to transfer your equity into another property we own ourselves, because a lot of the properties they own were not syndicated, so they were just the only investors. We're going to transfer all your equity into another property you own within first property across from a state university campus in Texas. And that process took about a year. There was legal and accounting challenges they had to get through. And I'm still on that property today. It's still cash flowing for me today. So my only foreclosure ever was actually not even a true foreclosure. It was a transfer of interest to another.
Wow.
Property, right? So there's a lot of learnings there. So the first thing is diversification is so important, because I can give you 20 ways a deal can go bad, right? It could be a fire. It could be a fire where the insurance isn't paying and you don't have money to repair it, and that's causing you to not have enough rent to come in to service the debt. It could be fraud, mismanagement, Ponzi scheme. It could be a freak tornado in that location. It doesn't have to, I can give you 20 ways a deal can go bad, including the bridge is being closed across from campus, right? So diversification is key when you do this type of investing, because there's always risk. That's number 1. Number 2 is who you're making a bet on is so important, because these people, without any legal obligation, without any reasonable assumption that they could have predicted any of this, you know, still felt bad and decided to transfer everybody's equity out of their own equity, right? And I won't even get into the fact that a partial recourse loan they had to pay out themselves on top of it all. It was a very expensive endeavor for them. Now, what's interesting lesson about that is that that sponsor was pretty high net worth and had the ability to actually fix the problem for investors, right? Not everybody's like that. So it's interesting how it could be an advantage to investing with a wealthy and experienced sponsor, but only if the sponsor has the mindset that they actually want to help and fix the problem. Because just because they have the ability to, it doesn't mean they're going to transfer everybody to, because they really probably had no legal liability, right? So there's a lot of learnings there, and I just want to point out there's a whole positive and negative learnings, but it's a story I like to repeat because it's so unique, and it just goes to show you how important diversification is, along with all of these other factors that we talked about.
Yeah, that's great. I think it's super helpful for everyone to hear stories like this too, because we've been in such a good market in these last few years that everyone is seeing through rosy lenses. So it's helpful to see that things can go bad, and when they do, it can get really bad. So you need to make sure I think that's when it's most important. That's when true colors show from these sponsors, is when you get into those ugly situations.
Yes, 100%. And a wealthy sponsor can always choose to make up for a cash call that may have been needed otherwise. They can make a loan to the property, right? Even if it's for a good reason. If you have tenant improvements for retail center because you have a brand new big tenant coming in, then there's a lot of money up front that's needed that wasn't forecasted. So, the sponsors can make a big difference in many different ways.
What is it that motivates you?
I love what I'm doing. And I also love networking with other people. I love helping people. I love just being on this podcast with you and just sharing this information. I love it because I just know that we're helping people. And so I just love that general philosophy. And I try to do it as much as possible and as best as I can. My kids definitely motivate me big time. They're 13 and 10. They're great. I've always been passionate about investing, but what I loved once I left the corporate world, I felt like I was maximizing my situation for my family and myself. And so what always bothered me about the corporate world, despite the fantastic jobs that I had, great job at Disney headquarters, great job at Toyota headquarters, but I was one of 10,000 people. And I always felt like they were not maximizing my potential. And there was no really way out of it because it was such a big organization, et cetera, right? Except short of being the president and all that type of thing. So I really feel like I'm spending all of my time maximizing my potential and maximizing the network and cash flow for my family, not just for this generation, potentially for future generations. And that is just such a great motivator. And then you add on the fact that I love what I'm doing, and it all adds up very well. So,
love it.
Yeah.
Well, definitely can say you add a ton of value to the real estate community, and we appreciate that you jump on a show like this to give back and be able to share the nuggets that you've accumulated over the last 20 years or so investing. So where can listeners find you online, and how can they best stay connected to you?
Yeah, absolutely. So I'm not really online. I don't do social media. I don't have a website. I'm just very under the radar, but anyone's welcome to reach out to me via email. My email is jroll, JROLL, at Roll Investments, ROLL, investments with an S.com. So jroll at rollinvestments.com. I guess the only place you will find me is if you Google my name and the word podcast. I'm on over 100 podcasts in the last few years. So, across different topics. So that would be one place you would find me, I guess. But please don't hesitate to reach out to me. I'm happy to help any way that I can. Happy to network as well.
Excellent. We'll definitely encourage everyone to stay plugged in with Jeremy and reach out and connect. So Jeremy, thanks so much for coming on the show.
Oh, no problem. Yeah, thanks for having me on. I really appreciate it. Hopefully this will be helpful for your listeners.
My pleasure. Thanks for tuning in and joining us on another episode of Operators and Allocators, hosted by the Requity Group, a vertically integrated private equity real estate company. You can find recordings of all shows along with other resources on our company website, therequitygroup.com, also listed in the show notes. A brief disclaimer to our listeners. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. All investments are subject to risk, and past performance is no guarantee of future results. The views and opinions expressed by the Requity Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions. We hope to see you next week.